For years, Wall Street treated crypto like a dangerous casino. Then something changed. The same financial institutions that once warned about digital assets began studying stablecoins, tokenized deposits, and settlement on blockchain rails. So why would banks suddenly care about stablecoins? The answer is not hype. It is plumbing. A stablecoin is useful to Wall Street for one very simple reason: it can move value like software. It can settle around the clock, travel across platforms, and plug directly into APIs, trading systems, wallets, and automated agents. That matters because the traditional financial system still has friction everywhere. Card payments are built for consumers. Wire transfers are slow and expensive. International settlement can take days. Market infrastructure closes, reopens, batches transactions, and depends on a long chain of intermediaries. But software does not sleep. Markets are becoming more global, more automated, and more real-time. If an AI agent, a trading platform, or a digital marketplace can move information instantly, it eventually wants money to move the same way. This is where stablecoins become interesting to banks. Not because banks suddenly love crypto culture, but because stablecoins point to a faster settlement layer. Think about what a bank actually sells. It sells trust. It sells access to money. It sells compliance, custody, identity, and risk controls. If payment tokens become normal, banks do not want to watch that business move outside the banking system. They want to provide the regulated version of it. That is why you hear two phrases more often now: stablecoins and tokenized deposits. A stablecoin is usually issued by a company and backed by reserves such as cash or Treasury bills. A tokenized deposit is different. It is bank money represented as a token, designed to move on programmable rails while staying inside the banking relationship. For users, both can feel similar: digital dollars that move quickly. For banks and regulators, the difference is huge. Who holds the reserves? Who can redeem? Who checks compliance? Who can freeze funds after fraud? Who is responsible if something breaks? Those questions are why regulation matters so much. The moment stablecoin issuers face clearer rules around reserves, redemption, licensing, audits, and anti-money laundering controls, stablecoins stop looking only like crypto products. They start looking like financial infrastructure. And there is another reason Wall Street pays attention: reserves. Many dollar stablecoins hold short-term US government debt. That means large stablecoin systems can become major buyers of Treasury bills. In other words, stablecoins do not just connect to crypto markets. They connect to the dollar system itself. Now imagine the next layer. Stocks, bonds, funds, invoices, private credit, and even real estate claims can be represented as tokens. If the asset is tokenized but the cash leg is still slow, the system is incomplete. Stablecoins and tokenized deposits provide the cash side of tokenized finance. That is the real prize, not a flashy coin, but a market where assets and money settle in the same digital environment. For Wall Street, that could mean faster collateral movement, cheaper back-office operations, 24-hour settlement, programmable compliance, and new products for clients who already live in digital markets. But this future is not risk-free. Stablecoins can face redemption pressure. Issuers can become too concentrated. Smart contracts can fail. Wallets can be hacked. Compliance can become invasive. And if a stablecoin becomes deeply connected to traditional finance, problems in one system can travel into the other. That is why the battle is not simply banks versus crypto. It is a fight over who controls digital dollars. Crypto companies want open rails. Banks want regulated rails. Governments want visibility and control. Technology companies want payments that work like APIs. And users want money that moves instantly without becoming a surveillance trap. So when Wall Street says it is interested in stablecoins, do not hear, they discovered a new meme coin. Hear this: the financial system is preparing for a world where money moves at internet speed. This is not investment advice. It is not a prediction about the price of any asset. It is a map of a shift already underway. The first era of crypto was about speculation. The next era may be about settlement. And if that is true, the most important stablecoin story is not the coin. It is the rails underneath the entire financial system.